Ladies and gentlemen, Japan just became America's largest creditor. $1.13 trillion in United States Treasury securities as of November 2024. That's not a prediction. That's Treasury Department data. And if you think this is just a financial footnote, just some boring reshuffling of numbers that doesn't affect your life, I need you to understand something right now. Japan is selling. China is selling. The two nations holding $2.24 trillion in American debt are simultaneously walking away from treasury auctions for the first time since the 2008 financial crisis. And when your biggest creditors stop buying your debt, everything built on top of that foundation becomes unstable. Your mortgage rate, your job, the interest Washington pays on $36 trillion in national debt. All of it is connected to what's happening right now in the treasury market, and almost nobody is talking about it. My name is Ryan, and for the past decade, I've been reverse engineering how global capital flows affect ordinary Americans, not the stuff they teach you in economics class. The real mechanics. The hidden leverage points where decisions made in Tokyo boardrooms determine whether you can afford a house in Ohio. And what I'm about to show you is the most dangerous buyer shortage crisis in modern American history. If you want to understand how the global financial system actually works, and more importantly, how it's about to affect your wallet, make sure to hit that subscribe button and give this video a thumbs up if it helps you see what's really happening behind the headlines. Because here's my promise to you. By the end of this video, you'll understand why Japan's quiet retreat from treasury markets matters more than anything happening in the stock market, in crypto, or in precious metals right now. The treasury market is the foundation of all asset pricing, and that foundation is cracking. Here's what everyone thinks they know. China has been America's biggest creditor for years. They hold our debt. We owe them money. That's the narrative. But that narrative just changed. In late 2024, Japan overtook China as the largest foreign holder of United States Treasuries. Tokyo now holds $1.13 trillion. Beijing holds $1.11 trillion, a gap of $20 billion. That's the headline. But here's what nobody is telling you about that headline. Both of them are selling. Japan reduced its treasury holdings by approximately $52 billion between mid-2024 and late 2025. China dumped $188 billion in the same period. That's according to the United States Treasury TIC data from December 2025. Let that sink in for a second. Your two largest creditors, holding more than $2 trillion combined, are simultaneously stepping back from the market. Now I know what you're thinking. Why does this matter? The government can just borrow from someone else, right? That's the trap right there. Because when creditor nations retreat simultaneously, yields must rise to attract replacement capital. Higher yields mean higher interest rates. Higher interest rates mean higher mortgage payments for you, higher corporate borrowing costs. And here's the part that should terrify you. Higher interest payments on the national debt itself. Annual interest on America's $36 trillion national debt reached $1.163 trillion in fiscal 2025. That's Treasury Department data. $1,163 billion. That's 23% of federal tax revenue going just to service the debt. Not to build roads, not to fund schools, not to pay for defense, just interest. And every 1% increase in rates adds approximately $360 billion annually to interest costs once existing securities roll over. That's Congressional Budget Office projections from January 2026. You're not watching a story about international finance. You're watching the early stages of a debt spiral that will directly tax your paycheck, your savings, and your future. Now let me show you the mechanics that mainstream media completely ignores. Because if you understand how this buyer shortage works, you'll see why this is different from every other treasury sell-off in modern history. The United States Treasury issues bonds to fund government operations. When tax revenue doesn't cover spending, which it hasn't in decades, Washington borrows the difference by selling treasury securities. Bonds, notes, bills, different terms, same concept. IOUs backed by the full faith and credit of the United States government. Foreign governments, central banks, institutional investors, and domestic buyers purchase these securities. They're considered the safest investment in the world because America has never defaulted. As of January 17, 2026, total foreign holdings of United States debt stand at approximately $8.5 trillion. That's Federal Reserve data. That represents 24% of the $36 trillion total national debt. The rest is held domestically. The Federal Reserve holds 16%. Mutual funds hold 11%. Banks hold 8%. The remainder is scattered across pension funds, state governments, and individual investors. Here's the critical part. That 8.5 trillion in foreign holdings used to be growing every year. Foreign creditors kept buying because Treasury securities offered safety, liquidity, and positive returns when converted back to their home currencies. But something changed in 2024. The Bank of Japan ended negative interest rates in March 2024 after 17 years. Let me explain why that matters, because this is the hinge point that changes everything. For 17 years, Japanese institutional investors faced negative interest rates at home. If you're a Japanese pension fund or insurance company, you couldn't earn positive returns on domestic bonds. You had to go abroad. United States Treasuries were the obvious choice. Safe, liquid, denominated in the world's reserve currency, and yielding positive returns when domestic Japanese bonds were literally costing you money to hold. So Tokyo accumulated $1.13 trillion in Treasury securities. That wasn't charity, that was survival. But in March 2024, the Bank of Japan raised rates above zero for the first time since 2007. Japanese government bonds started yielding positive returns again, and suddenly, Japanese institutional investors had a choice. They could buy United States Treasuries and take on currency risk, or they could buy domestic bonds with no currency risk and still earn positive returns. Here's what currency risk means in practice. The yen appreciated 8.7% against the dollar between October 2024 and January 2026. That's Bank of Japan data. If you're a Japanese investor holding dollar-denominated assets, that appreciation wipes out nearly 9% of your returns when you convert back to yen. A United States Treasury yielding 4% suddenly yields negative 5% in yen terms after currency conversion. That's not theoretical, that's math. And Japan's not just some small player you can ignore. Tokyo holds $4.23 trillion in foreign exchange reserves as of January 2026. That's the second largest stockpile in the world after China. The Japanese government pension investment fund alone manages $1.7 trillion in assets, and in November 2025, they announced a rebalancing. They're reducing foreign bond allocation from 25% to 20%. Sounds small, right? 5 percentage points. That's a $63 billion shift. $63 billion of selling pressure on treasury markets from one institution. Now we're getting to the part that actually matters. Everything before this was just context. Because here's where the cascading implications hit American households. The 10-year Treasury yield determines mortgage rate benchmarks. When Treasury yields rise, mortgage rates rise. The 10-year yield climbed from 3.88% in September 2024 to 4.67% by January 2026. That's Federal Reserve H.15 data. Less than 2 years. Nearly 80 basis points. Let me show you what that means for an actual human being trying to buy a house. You want to finance $400,000. Standard 30-year fixed mortgage. At 3.88%, your monthly payment is $1,879. At 4.67%, your monthly payment is $2,291. That's an additional $412 per month. $412 you don't have because Japan and China stopped buying treasuries. Over 30 years, that's $148,320 in extra interest payments. A direct tax on American homeownership caused by foreign creditor withdrawal. And before you say that's just how markets work, that rates go up and down, let me show you why this time is different. Because the timing couldn't be worse. $1.4 trillion in corporate bonds mature between 2026 and 2027. Bureau of Economic Analysis data from Q3 2025. Companies that borrowed at 2 or 3% 5 years ago now have to refinance at 5 or 6%. That's 200 to 300 basis points higher. What do corporations do when borrowing costs spike? They cut costs. They freeze hiring. They lay people off. You might still have your job today, but your company's CFO is looking at refinancing costs right now and making decisions about next quarter's headcount. That's the hidden cost of Japan's treasury sell-off. It's not just numbers on a screen, it's your coworker getting walked out with a box of their belongings 3 months from now. Now here's where it gets really dangerous, and I need you to stay with me because this is the doom loop that terrifies anyone who actually understands sovereign debt dynamics. When creditor nations retreat, yields rise to attract replacement buyers. Higher yields increase the government's interest costs. Higher interest costs require more borrowing. More borrowing requires finding more buyers. But the buyers are already walking away, so yields have to rise even more. You see the problem? It's a self-reinforcing cycle. Remember that $1.163 trillion in annual interest payments I mentioned earlier? That number assumes average rates stay roughly where they are, but they're not staying where they are, they're rising. Office of Management and Budget projections from 2026 estimate that if average rates on the national debt rise just 1%, annual interest costs increase by $360 billion once securities roll over. The entire national debt doesn't reset overnight. It rolls over gradually as bonds mature. But over the next 5 years, roughly $15 trillion in existing Treasury securities will mature and need to be refinanced at whatever rates prevail at that time. If rates are 2% higher when that refinancing happens, that's $300 billion per year in additional interest costs. Every single year, forever, until rates come back down or the debt is paid off. And America hasn't run a budget surplus since 2001. The debt isn't getting paid off, it's getting refinanced. Let me give you the comparison that makes this clear. In 2000, annual interest on the national debt was $230 billion. Total national debt was $5.7 trillion. Average interest rate was about 4%. Today, the debt is $36 trillion. Interest payments are $1.163 trillion. Average rate is about 3.2%. We're paying 5 times more in interest on 6 times more debt at lower rates than we had in 2000. What happens when rates aren't lower anymore? This is what I meant when I said the foundation is cracking. Because here's the part that nobody wants to say out loud. 47% of United States Treasuries are now held domestically by the Federal Reserve, mutual funds, and banks. The American financial system is buying its own government's debt. That's not normal. That's not healthy. That's the definition of monetary debasement. When a country's central bank prints money to buy its own government's bonds because foreign creditors won't, that's how you get currency crises. That's how you get inflation that doesn't go away. If you've made it this far, you're already ahead of 90% of people who have no idea this buyer shortage is even happening. But don't stop now. Because what comes next is the geopolitical leverage principle that changes how you think about American power. Here's what they don't teach you in school about international relations. Military might matters, economic size matters, but creditor leverage matters more than both. Because Japan and China don't need to fire a shot to influence American policy. They just need to stop showing up to Treasury auctions. That's veto power without declaring war. Think about what that means in practice. Washington wants to impose sanctions on Beijing. China can dump another $100 billion in treasuries and spike American borrowing costs. Tokyo disagrees with United States trade policy. They can rebalance their portfolio and force the Federal Reserve to choose between higher rates or more money printing. This isn't conspiracy theory. This is game theory. This is how leverage works in the modern financial system. And both nations know it. China has been systematically reducing treasury holdings since 2013. They peaked at $1.31 trillion in November 2013. They're down to $1.11 trillion now. That's a reduction of $200 billion over 12 years. Slow, methodical, strategic. They're not dumping everything at once because that would crater their own portfolio, but they're clearly moving away from dollar dependence. Japan's move is newer and more shocking because Tokyo has been Washington's most reliable creditor for decades. The United States-Japan alliance is the cornerstone of American strategy in Asia. Tokyo buying treasuries wasn't just investment. It was geopolitical alignment. It was how Japan showed support for the dollar-based global order. But now, even Japan is pulling back. Not because they hate America. Because the math changed. Because domestic returns are finally positive. Because the yen is strengthening and dollar assets are becoming less attractive. This is what financial sovereignty looks like when it starts to erode. You don't lose it all at once. You lose it gradually as creditors diversify away from your debt, as they realize they have options, as the calculation shifts from must buy to maybe buy to why buy. Now let me tie all of this together, because when you see how these pieces connect, everything changes. The buyer shortage isn't just a Japan story or a China story, it's a structural story about what happens when the global appetite for United States debt shrinks at the exact moment Washington needs to borrow more than ever. The Congressional Budget Office projects federal deficits will average $2 trillion per year for the next decade. $2 trillion. Every year. That debt has to be sold to someone. For 30 years, foreign creditors absorbed a huge chunk of it. They're not absorbing it anymore, they're reducing. So who fills the gap? Option 1. Domestic buyers. Banks, mutual funds, pension funds, individual investors. But domestic buyers are already holding near record amounts, and they're price sensitive. They won't buy unlimited quantities at current yields. If you want them to buy more, yields have to rise. Which brings us back to the doom loop. Option 2. The Federal Reserve. The central bank can print money and buy treasuries directly. They did exactly that during COVID. The Fed's balance sheet exploded from $4 trillion in early 2020 to $9 trillion by 2022. Then they tried to shrink it through quantitative tightening. As of January 2026, the balance sheet sits at $7.2 trillion. That's Federal Reserve data. If foreign buying continues to decline, the Fed will have to choose: let yields spike and risk recession, or restart quantitative easing and risk inflation. Neither option is good. Both options hurt ordinary Americans. Higher yields mean higher mortgage rates, higher corporate borrowing costs, slower economic growth, more layoffs. More quantitative easing means more money printing, more inflation, more erosion of purchasing power. Your paycheck buys less every year, even if the number on your paycheck stays the same. This is the trap Washington is in. And Japan's decision to reduce Treasury holdings just made that trap tighter, because Tokyo was the escape valve. When China reduced holdings, Japan picked up the slack. When domestic appetite waned, Japan kept buying. Now Japan is walking away too. There is no backup buyer at current yields. Let me show you what this looks like in human terms, because numbers on a screen don't capture the real cost. You're 28 years old. You've been saving for a down payment for 3 years. You finally have enough. You find a house you can afford at 3.8% rates. But by the time you get approved, rates hit 4.67%. That $412 per month difference? That might be the difference between qualifying for the loan or not. Between owning a home or renting for another 5 years. Between building equity or paying someone else's mortgage. You're 45 years old. Your company is refinancing debt. Interest costs are eating into margins. Management announces layoffs. You've been there 15 years. Solid performer. But you're in a department that's not directly revenue generating. You're let go. Not because you did anything wrong. Because Japan stopped buying United States Treasuries and your company's borrowing costs doubled. You're 62 years old. 3 years from retirement. Your 401k is heavily invested in bond funds because you're de-risking as you approach retirement. Treasury yields spike. Bond prices fall. Your portfolio drops 8% in 6 months. That's 3 years of gains erased because foreign creditors walked away and yields had to rise to attract new buyers. These aren't hypotheticals. These are the second-order effects of the buyer shortage crisis that's happening right now. The stuff that doesn't make headlines but ruins lives. Now, I can already hear the objection forming in your head. Okay, Ryan, this sounds bad. But what am I supposed to do about it? I can't control what Japan does. I can't force the Treasury to balance the budget. So why does understanding this help me? Here's why. Because when you understand the game, you can position yourself differently. You can't stop the storm, but you can build a better shelter. If you know mortgage rates are structurally higher because of creditor withdrawal, you lock in rates now instead of waiting. If you know inflation is likely because the Fed will have to monetize more debt, you shift assets accordingly. If you know corporate layoffs are coming because of refinancing pressure, you build a bigger emergency fund and diversify your income streams. The people who get destroyed by macro shifts are the people who never saw them coming. The people who survive and thrive are the people who understood the leverage points and adjusted before everyone else panicked. That's what this video is for, not to scare you, to arm you with information that 99% of people don't have. We're in the home stretch now, and I saved something important for the end, because the Japan story isn't over, it's just beginning. The $63 billion government pension investment fund rebalancing I mentioned earlier, that's scheduled to happen over the next 2 years. That selling pressure hasn't fully hit markets yet. China still holds $1.11 trillion. If they accelerate their reduction, if they match the pace Japan set in 2025, that's another 50 to 100 billion in selling pressure over the next 12 months. And here's the thing nobody is pricing in: the example effect. If Japan and China both reduce treasury holdings and nothing catastrophic happens, other creditor nations might follow. Saudi Arabia holds 135 billion. The UK holds 720 billion. If they start thinking the same way Tokyo is thinking, if they decide domestic returns are better than dollar exposure with currency risk, the buyer shortage becomes a buyer exodus. That's the scenario that keeps Treasury officials up at night. Not that Japan sells 50 billion, but that Japan's selling gives permission for everyone else to sell too. That the stigma of walking away from treasuries disappears. That's when yields don't just drift higher. That's when they spike. I'm not saying that's guaranteed to happen. I'm saying the conditions are in place for it to happen. And if you're watching this video, you're now aware of those conditions, while most people are completely blind to them. That's the edge. Not a guarantee of safety, but awareness when everyone else is asleep. Your future self is depending on the decisions you make right now. The house you buy or don't buy. The debt you take on or avoid. The assets you hold or sell. The income streams you build or ignore. All of those decisions should be informed by what's happening in the Treasury market right now. Because the Treasury market is the foundation of everything. When that foundation cracks, everything built on top of it shifts. 10 years from now, you'll look back at this moment. You'll remember when Japan became America's largest creditor and then immediately started selling. And you'll either think, I saw that coming and positioned myself accordingly, or you'll think, I had no idea that was even happening. The difference between those two outcomes is information, and you have that information now. So here's what I want from you. Tell me in the comments. What financial topic is keeping you up at night? What's happening in your life right now that you can't find a straight answer on? Inflation, real estate, interest rates, corporate debt, the dollar, gold, whatever it is. Drop it below, because that's what this channel is for. Cutting through the noise and showing you what actually matters. And if this video helped you see something you weren't seeing before, hit that thumbs up so more people can find it. The boulder isn't just rolling uphill anymore. The hill is getting steeper. And the people who were supposed to help you push just walked away. But now you know why. And knowing why is how you stop pushing boulders and start building systems that work without you. That's the shift. That's the game. And you're already ahead just by watching this far.